two Canadians. Same $100,000 US dividend portfolio. Same income. Same contribution room. One of them is on track to leak $15,000 over their lifetime to a tax most Canadians don't know they're paying. And it is hiding in the one account they thought was safe, the tax-free one. Here is why the word tax-free has an asterisk the banks never show you, which account the trap is actually in, and the 4-box decision that tells you where every U.S. holding you own belongs. The word tax-free in that account was written by the Canadian government. The United States never signed it. When an American company pays a dividend to a Canadian investor, the Americans take their cut first, 15%, off the top, every dividend. First, what the 15% actually is and why it exists. Second, why the TFSA, the one account every Canadian is told to trust, has no protection against it. You walk away with the real dollar number on a $10,000 position. Third, the workaround most viewers think they already found. If you own VFV or XUU or ZSP, you need to hear what comes next. And fourth, the full decision matrix. Every U.S. holding you own, every account you have, which account fits, and the 3 edge cases where the default does not apply. Before we dig in, a quick thank you to Moomoo for sponsoring today's video. More on how they fit this specific strategy at the end. Box 1. Here is the part the banks never sit you down and explain. When a U.S. company pays a dividend, the Internal Revenue Service looks at who is receiving it. If the receiver is American, the dividend flows through untouched. If the receiver is a foreigner, the default rate is 30%. Withheld at source. Gone before it ever leaves American soil. 30% would be brutal. Luckily, Canada and the United States signed a tax treaty back in 1980. Buried inside that treaty is a rule. Article 10, Section 2, Paragraph B. It drops the rate from 30% down to 15% for Canadian residents. That is what the 15% actually is, a treaty rate. Not a bank fee, not a brokerage charge. It is the Americans collecting their share of an American company's dividend before a Canadian ever touches it. To qualify for the 15% rate instead of the default 30%, the Internal Revenue Service requires a form called the W-8BEN, certifying you are a Canadian resident and eligible for the treaty rate. You did not file it. You do not even remember it, because your Canadian broker files it for you, automatically, the moment you opened the account. It renews every 3 years. You will likely never see it again. The 15% is happening silently, invisibly, on every single U.S. dividend that has ever hit any of your accounts. Nobody shows you the withheld amount on your statement unless you go digging for it. The coin that arrives in your account is already 85 cents on the dollar. So that is the mechanic. 15% off the top, before the dividend even reaches your account. The question is why the account you were told was safe does not stop it. That is box 2. Here is the ugly part about the TFSA and U.S. dividends. Article 21 of the Canada-U.S. Tax Treaty exempts retirement accounts from U.S. withholding on dividends. Direct-held U.S. stocks inside an RRSP pay 0%. 0. Article 21 does the work. The TFSA is not on that list. When the treaty was written, the TFSA did not exist. Nobody went back and added it. In the eyes of the Internal Revenue Service, a TFSA is not a pension. It is a regular Canadian account. Every U.S. dividend in your TFSA gets hit with the full 15%. Here is the twist. In a non-registered account, you claim the 15% back on Form T-2209, line 40500. The federal foreign tax credit can recover most or all of it because you have Canadian tax to offset. Inside the TFSA, you have no Canadian tax, nothing to credit against. The 15% is permanently lost. Meet Sarah, 52, Ontario, 90,000 income. She holds $10,000 of VOO, a direct US-listed S&P 500 ETF in her TFSA. VOO yields 1.3%. That is $130 a year in dividends. 15% of that is $19.50. Gone. Every year. Permanently. Sounds like nothing. A cup of coffee a month. Stay with me. Reinvested at an assumed 7% annual return over 25 years, 1950 compounds into roughly $1,200 to $1,500 on this $10,000 position. Scale it up. A $100,000 U.S. equity allocation in a TFSA is projected to bleed $12,000 to $15,000. That is the $15,000 the intro opened on. Real, quiet, already compounding. This is where it gets worse. There is a group who bought VFV instead of VOO. They think they already solved this. The 15% is still eating them alive. I will show you why next. Quick pause. If this clarified a 15% hole you did not know about, hit like. It tells YouTube to show this to the next Canadian with the same problem. Box 3. Here is where a lot of viewers tap out because they are about to find out they did not actually solve this. If you own VFV or XUU or ZSP or VUN, the big four Canadian-listed S&P 500 ETFs on the TSX, you are probably thinking, I avoided this whole problem. I bought the Canadian version. I do not touch US stocks. You are still paying the 15%. Moving those tickers to your RRSP does not recover the 15%. Here is why. Take VFV as the example. VFV does not own the S&P 500 directly. VFV is a Canadian wrapper that owns VOO. When a US company pays its dividend, it goes to VOO first. The Internal Revenue Service sees VOO receiving it, checks who the owner is, sees a Canadian ETF, and applies the 15% treaty rate right there, at the fund level, before VFV ever distributes a cent to you. XUU, ZSP, and VUN reach the same outcome. The treaty exemption in Article 21 only applies when the RRSP itself owns the US-listed security directly. It does not flow through a Canadian ETF wrapper. The Internal Revenue Service does not look through the wrapper. It sees VFV, not your RRSP, as the holder. And VFV is not a pension. If you hold VFV inside your TFSA, you pay 15%. If you hold VFV inside your RRSP, you also pay 15%. The withholding happens one layer above where you are holding the ETF. The conventional wisdom says, put your US stuff in the RRSP. That is only true if the US stuff is direct US-listed securities, VOO itself, a direct US-listed dividend ETF, a US-listed individual stock, not the Canadian wrapper. So the fix is not as simple as move everything to the RRSP. It depends on what you hold, how much it pays, and whether you have the RRSP room. Box 4 is where this becomes a decision you can make tonight. Here is the full map. The right account depends on 3 things: the yield, your RRSP room, and your retirement income picture. Run any move by your accountant first. Box 1. If you own a direct US-listed security, VOO-SCHD, a US-listed individual stock, that holding belongs in your RRSP. Article 21 exempts it. 0% withholding. On the $100,000 example, that is a 5-figure lifetime save over 25 years. Box 2. If you own a Canadian-listed US equity ETF, VFV, XUU, ZSP, VUN, keep it in your TFSA. Moving it to the RRSP does not recover the 15% because the withholding happens at the fund level. You already pay it. You will keep paying it. At least capture the tax-free capital gains shelter on the share price growth inside the TFSA. Box 3. Low-yield US growth names. If what you own is a US growth stock paying less than 1% in dividends, leave it in the TFSA. 15% of nothing is nothing. The capital gains shelter in the TFSA is doing real work. The 15% on a dividend that barely exists is not worth optimizing. Box 4. Maxed RRSP. If your RRSP is full and you want high-yield US dividend stocks, non-registered can outperform TFSA for this narrow case. You pay the 15% at source, then claim it back on Form T2209, line 40500. The federal foreign tax credit can recover most or all of it. A fallback when the RRSP is full. One more flag. If you collect or expect to collect the Guaranteed Income Supplement, do not move U.S. holdings into an RRSP or RRIF without a conversation first. RRSP and RRIF withdrawals count as income. TFSA withdrawals do not. GIS can claw back up to 50 cents on the dollar. The 15% you save can be wiped out by the GIS you lose. That is a conversation for your accountant, not a YouTube video. That is the map. Knowing the right answer and executing it are two different things. The last piece is where this strategy actually gets run. Quick disclosure. Moomoo Financial Canada sponsors this video and compensates this channel for referrals through the link below. What follows is based on Moomoo's published fee schedule and public regulatory registration, not on what they pay me. The strategy we walked through avoids that $15,000 leak, but only if your platform supports direct US-listed securities inside an RRSP. Moomoo Canada supports RRSP and spousal RRSP, which is what this strategy meets. They do not currently offer FHSA, RESP, or joint. So if you are building a full household plan, check their current account list before opening. They are a CIRO regulated dealer and a member of CIPF. They are order execution only, which means they do not tell you what to buy. They let you execute your own decision. Two costs matter for US investing from a Canadian account: currency conversion and commissions. Moomoo Canada currently waives the explicit FX conversion fee until further notice. Conversions run at their Moomoo preferred rate, which includes a spread that moves with the market. Commissions start at $1.49 Canadian on Canadian trades and $1.99 USD on US trades. Per share pricing is under a penny. For typical personal account sizes moving Canadian dollars into US holdings, that combination runs cheaper than the major Canadian bank-owned direct investing brokerages. Their published conversion spreads typically sit between 1.5% and 2.5%. In November 2025, Moomoo Canada received the Benzinga Global FinTech Chairman's Award in the Canadian US stock trading category. Moomoo is relatively new to Canada. They launched locally in 2023. The link in the description goes to their current welcome offer. Up to $300 in rewards tiered by deposit. $60 at a $1,000 deposit. $300 at $5,000. Terms apply. Check current details before signing up. One thing to do before you leave. If you hold any direct US-listed security inside your TFSA right now, VOO or any individual US stock, pull up your account. Look at it. Then sit with what you learned today for a day or two. Do not make a rash move. An FX conversion cost and a capital gain trigger both matter, and so does your RRSP room. Write down the question for your accountant before your next phone call. For VFV, XUU, ZSP, or VUN, moving these between accounts does not recover the 15%, and FX conversion to relocate them rarely pays off. For low-yield US growth stocks paying under 1% in dividends, the TFSA capital gain shelter is already doing the work. There is a second layer to this RRSP story. Beyond the Article 21 exemption, the RRSP does something else for US holdings that can shift your retirement timing by years. That is the next video. TFSA versus RRSP, the banker's secret mistake. The card is on screen at the end. If you want the rest of this series as it publishes, subscribe. Not your accountant. Do your own homework. Thanks for watching.